Why markets rallied today? Both Nifty and Bank Nifty soared today with Nifty gaining 1.17% to close at 21,601 and Bank Nifty jumping 1.68% to end at 40,915. This rally was fueled by a combination of factors including bullish Asian cues, budget anticipation, and sectoral strength. Markets across Asia performed well this morning, boosting investor confidence in India. The upcoming Union budget on February 1st has raised hopes for growth oriented policies and corporate tax cuts, further driving enthusiasm. Strong performance in key sectors like infrastructure, oil and gas, and FMCG boosted the indices. Most Nifty 50 constituents were in the green, with ONGC up by 7.5%, Adani Enterprises up by 6.8%, and Adani Ports up by 4.6%, leading the charge. Short covering in Nifty futures contract likely contributed up to the uptick. Nifty breached key resistance levels at 21,500 and 21,600, paving the way for further gains. HDFC Bank, ICICI Bank, and Kotak Mahindra Bank were among the top performers, indicating increased optimism in the banking sector. Recent reports of positive credit growth and declining NPAs in major banks boosted investor confidence. The recent dip in government bond yields provided some relief to banks, potentially improving their net interest margins. Global clues and FPI inflows are also another reasons. Despite mixed trends from US and European markets, the positive Asian sentiment outweighed negative cues. Although foreign institutional investors remained net sellers today, the selling pressure was relatively muted compared to recent days. Analysts remain cautiously optimistic about the short term outlook. The budget remains the key event to watch out for, and its impact on sentiment will be crucial. Profit booking cannot be ruled out in the near term, especially if global clues turn negative. However, if the budget manages to address investors' concerns and boost growth expectations, the current uptrend might continue. We have some important updates from the market that we will be discussing in this video regarding Adani Enterprises and the gas demand surge in 2024. And we'll also discuss about Zerodha's glitch in today's morning trading session. So before going to that, subscribe to our channel and also like the video. Today we have an update from an US brokerage firm regarding Adani Enterprises Limited. Cantor Fitzgerald and Co., a US brokerage firm, has expressed a positive outlook on Adani Enterprises Limited, the leading company within the Adani Group. Analysts Brett and Thomas from Cantor Fitzgerald initiated coverage with an overweight rating, highlighting the company's crucial role in India's economic aspirations. According to the analysts, Adani Enterprises represents a appealing risk-reward scenario at current levels. The brokerage has set a target price of 4,368 rupees, indicating a substantial 51% potential upside from the stock's recent closing price. This endorsement is expected to boost confidence in Adani's conglomerate, which faced challenges from a US short sellers report last year. Cantor's positive stance has contributed to the recovery of Adani Group, with the combined market value of its companies more than doubling from a low of $82 billion to $185 billion since February. The brokerage notes that Adani Enterprise valuation is primarily driven by its airports, roads, and new energy segments, offering investors additional businesses essentially for free. Addressing concerns raised by the Hindenburg report, Cantor acknowledges Adani's efforts to improve liquidity risk and governance. Despite the serious allegations, Cantor believes that Adani, given its significant presence, is now too big to ignore. Adani has consistently denied fraud accusations that had initially led to significant drop in the group's market value. In conclusion, Cantor Fitzgerald's optimistic view on Adani Enterprises reflect growing confidence in the company's strategic importance within India's economic landscape. This endorsement is likely to shape positive sentiment and influence Adani stock's performance in the future. Today we have another update and we are diving into the latest report from the International Energy Agency on India's natural gas sector. The International Energy Agency predicts a remarkable 6% surge in India's natural gas demand for the year 2024. What's driving this growth is about to find out. India's gas demand surge is primarily fueled by increased usage in petrochemical power generation, refinery, and industrial sectors. Taking a quick look back, India experienced a 7% decline in natural gas demand in 2022, but rebounded with a 5% year-on-year increase in primary gas supply in 2023. The IEA acknowledges India's significant stride in gas market reforms in 2023. This includes the introduction of a unified pipeline tariff system in April 2023. The unified tariff policy, implemented by the Petroleum and Natural Gas Regulatory Board, aims to create a fair and consistent tariff structure for natural gas transport across the country. This policy is expected to bring stability, competition, and transparency to gas pricings, benefiting both supply and demand. It aligns with the One Nation, One Grid, One Tariff model. To enhance supply security, India is considering the establishment of strategic gas reserves. This move follows the Energy Transition Advisory Committee's suggestion in May 2023. Zooming out globally, China regained its position as the world's largest LNG importer in 2023, with a 7% increase in natural gas demand. Meanwhile, Europe saw a 7% decline, the lowest since 1995. The global energy crisis triggered by geopolitical events puts natural gas supply at the forefront of global energy policy. Globally, gas demand is forecasted to grow by 2.5% in 2024, with a focus on Asia Pacific and gas-rich countries in Africa and the Middle East. Exciting times ahead of India's natural gas sector. Today we have another breaking news from the world of online trading as the popular stockbroking platform Zerodha faced yet another technical glitch on January 29th. One user shared, "Yes, I too am affected. My 5000 rupees profit became 800 rupees and I had to exit at 880 rupees. Couldn't execute other trades. We deserve compensation." Another user urged Zerodha CEO Nitin Kamath saying, "Dear sir, podcast baad mein record kar lena. Zerodha is down again, people are losing money." At 9:44 am, Zerodha released a statement stating the issue is resolved. Due to a connectivity issue, some of our users faced issues with order placement on Kite. We are working on this and fixing this. This isn't the first time Zerodha has encountered technical problems. Similar issues were reported on December 4th and November 6th. Zerodha acknowledges the problems and states, "The issues on November 6th and December 4th were triggered due to edge cases with our external dependencies. This is no excuse, and I understand that as a platform, we are responsible for all the issues you face. It's not just Zerodha. Its rival, Grow, also faced a glitch last week. Clients complained about being unable to log in and carry out trades, resulting in losses. Grow responded, 'We apologize for the inconvenience. Our team is addressing a technical issue and working to resolve it promptly.' Similar to Zerodha users, clients on Grow demanded compensation for their losses. The incident highlights the challenges faced by online trading platforms in maintaining seamless services for their users. That's all we have for today. If you really like this video helpful at any point of time, don't forget to like this video and also subscribe to our channel Financial Radio. Thanks for watching.